Inside a white marble building on Constitution Avenue in Washington, D.C., 12 individuals gather around a massive table. Above the entrance, the words Federal Reserve are carved into the stone, signaling the weight of the decisions made within. These 12 people hold the single most consequential economic lever on the planet. Every 6 weeks, they set the interest rates that dictate the cost of borrowing money across the world's largest economy. Their decisions ripple through every 30-year mortgage, every auto loan, every corporate bond, and every government treasury. It affects the credit card balances of every American family trying to make ends meet. On Saturday, March 7th, these policymakers confronted a set of data that no Federal Reserve model was ever designed to process. Brent crude oil surged to $91 a barrel, marking a staggering 24% increase in just 8 days. U.S. crude recorded its most aggressive weekly gain in history, pushing national gas prices to an average of $3.32 per gallon, the highest since September 2024, and they are still climbing. In Europe, natural gas prices nearly doubled in a single week. For the first time in recorded history, both the Strait of Hormuz and the Red Sea have become simultaneously inaccessible. Even before the first missile was launched, U.S. inflation was already trending at 2%, well above the Fed's 2% target. The Producer Price Index, PPI, had climbed 3.6% year-over-year. Simultaneously, the U.S. economy shed 92,000 jobs last month. Amidst this volatility, the president is publicly demanding lower interest rates while managing the most expensive military operation since the Iraq War. The 12 people in that marble building are trapped. There is no exit strategy that doesn't result in something catastrophic for someone. This situation is genuinely terrifying, not in the visceral way of missile footage, but in the way that something destroying your family's financial security is always more haunting. The Federal Reserve operates under what it calls a dual mandate. They have two primary jobs: keep inflation near 2% and keep employment high. Usually, these two objectives pull in the same direction. When the economy slows and unemployment rises, the Fed cuts rates to stimulate borrowing and spending, which brings jobs back while keeping inflation low. Conversely, when the economy overheats and inflation rises, the Fed raises rates to cool spending and stabilize prices. The entire system was designed for a world where inflation and unemployment move in opposite directions. However, the conflict in Iran has forced them into the same direction at the same time. The loss of 92,000 jobs last month is a flashing recession warning. In any normal era, the Fed's response would be to cut interest rates to encourage hiring and growth. That is the standard playbook. But the playbook is being torn up. Oil is at $91 and rising. Inflation is already over the target. Shipping routes are disrupted, and supply chains that had finally stabilized after the pandemic are fracturing once again. Rice exports are stranded at Indian ports, and fertilizer prices are spiking. Every product transported by ship is becoming more expensive because insurers have effectively repriced the entire ocean. Goldman Sachs now models inflation reaching 3% by year-end if oil stays at these elevated levels. The Producer Price Index is already at 3. This is a pipeline reading, representing what businesses are paying now for inputs that will become consumer prices in 60 to 90 days. If the Fed cuts rates to save jobs, it effectively pours gasoline on the inflation fire. The dollar weakens and import prices rise. Every barrel of oil and every foreign-made good becomes more expensive in dollar terms. In this scenario, inflation doesn't just persist, it accelerates. 5 years after the pandemic taught Americans the pain of runaway prices, the Fed would be seen as choosing inflation over jobs, a political burden they would own entirely. Conversely, if the Fed holds or raises rates to fight inflation, they abandon the workforce. The 92,000 people who just lost their jobs would receive no relief. Businesses already squeezed by tariffs and slowing growth would be hit even harder. Mortgages and car loans would remain unaffordable, and a housing market already frozen by years of high rates would stay locked. The economy the president promised to fix would only break further. There is a specific name for this scenario where inflation rises while growth slows: stagflation. The last time America faced this was in the 1970s, a decade defined by gas lines, 13% inflation, and 10% unemployment. It took a Fed chair like Paul Volcker raising rates to 20% to break the cycle, which triggered the worst recession since the Great Depression. Joe Bruswalis, chief economist at RSM, put it bluntly, the Fed's reaction function is going to experience a real stress test. The risk of stagflation permeates the air, and all eyes will continue to be focused on the direction of energy prices. The crisis isn't just an economic policy problem, it is a political one. Jerome Powell's term ends in May, and the man chosen to replace him, Kevin Warsh, is currently in the Senate confirmation queue. Warsh was selected by Trump because they share a fundamental belief: interest rates should be lower. Warsh has argued that rates should be below the current 3.5% to 3.75% range. However, Warsh's economic philosophy has a glaring vulnerability in the current climate. He tends to downplay the impact of oil prices on inflation, treating energy spikes as temporary events that don't require a monetary policy response. In a normal world with a short-lived geopolitical flare-up, that framework might hold water. But this is not a normal spike. The Strait of Hormuz is closed. Brent is up 24%. The producer pipeline is running hot. International markets are in a tailspin. South Korea's Kospi crashed 12% in a single day, and the Thai Stock Exchange had to impose trading curbs. If Warsh cuts rates now, he risks fueling an inflationary fire. Internal dissent is already brewing at the Federal. I had a lot of confidence up until a couple of days ago. Now, we need more data, said Minneapolis Fed President Neil Kashkari. We need to see how persistent this is, added New York Fed President John Williams. Warsh needs a majority of the 12-person committee to cut rates, but while he has the president's support, he does not yet have their votes. Every week this war continues, and every dollar oil rises makes those votes harder to secure. Bloomberg Economics describes the Fed as being in an impossible position, not difficult or challenging, but impossible. For the ordinary American family, these abstractions translate into harsh kitchen table realities. Every $10 increase in oil adds 0.2 percentage points to inflation. That math is already being priced into goods arriving on shelves in the next 2 months. Rice shortages in India will soon manifest as food price hikes in American grocery stores. Spiking fertilizer costs will bleed into next season's crops. Shipping routes diverted around the Cape of Good Hope add weeks to voyages, and those costs are passed from importers to retailers to consumers who are already exhausted by 5 years of high prices. Former Treasury Secretary Janet Yellen noted that this situation makes the Fed even more reluctant to cut rates than they were before. Meanwhile, the administration continues to signal more war. Quadrupling weapons production and launching bombing campaigns against Iranian launchers suggests a longer, larger conflict. More war means more oil disruption, which means higher prices, which means the Fed cannot cut rates. If they cannot cut, mortgages stay high, borrowing stays costly, and the job market continues to bleed. The affordability message the president campaigned on is being swallowed by a war whose economic consequences were never modeled. Stephen Brown of Capital Economics noted, it is getting harder to envisage Fed Chair nominee Kevin Warsh persuading the rest of the Fed to support further interest rate cuts until there is firmer evidence that inflation is on a path back to 2%. Every drone intercepted and every day the strait remains closed drives oil prices higher and inflation further from the target. The missiles are flying in the Gulf, but the economic shrapnel is already headed for every American family's bank account. There is no defense system for stagflation, and no budget line can protect against the inflation that arrives when global trade routes stay closed for months. The economic shrapnel has already breached the perimeter. The risk of stagflation, inflation plus recession, is no longer a fringe prediction, it is the primary threat. The war that was never modeled has made the promised rate cuts nearly impossible. Day 8, the missiles are flying, and the crisis is only beginning.